Hello, in this video, we're focusing on the practical concepts that you can actually apply in the real business world. Hope you enjoy it. Let's get on with it. Welcome, and thanks for joining this overview on reverse takeovers. Today, we'll explore how companies can go public through this process as an alternative to traditional methods, and we'll break down its key components in simple terms. As we move through, I'll explain how reverse takeovers fit into the larger picture of corporate finance and why they matter. Let's get started. In corporate finance, going public is often viewed as the ideal way for companies to access permanent capital, offer liquidity to shareholders, and boost their visibility in the market. Usually, this happens through an initial public offering, or IPO. But IPOs can take a lot of time and money, and they're very sensitive to how markets are doing at that moment. When market conditions are unstable, or when a company's unique situation doesn't match the typical IPO story, other routes to going public become worth considering. One such option is the reverse takeover, sometimes called a reverse merger. This method lets a private company become public by buying control of a company that's already listed on the stock exchange, essentially flipping the usual buyer-seller relationship. Throughout this video, we'll walk you through everything you need to know about reverse takeovers, from what they are and why companies choose them, to how they work in practice, including real examples and the strategic pros and cons. This is designed to give you practical knowledge that can help business owners, executives, investors, and advisors make informed decisions. A reverse takeover happens when a private company buys a public company, but the private company's shareholders gain control over the combined business. Even though it might look like the public company is the buyer legally, the private company is really the one acquiring the public listing and the benefits that come with it. Usually the public company involved is a smaller, inactive one, or what's called a shell company, which mainly exists on paper. The private company brings its business into this shell by injecting assets or operations, and then new shares are issued to the private company's shareholders. This leads to a change in control, with management and the board coming from the private company's side. After the transaction, the new combined entity stays public, which means the private company effectively becomes a public company without going through a traditional initial public offering. Meanwhile, the shareholders who owned the shell company before are diluted. Simply put, a reverse takeover is a faster, sometimes simpler way for a private company to enter the public market. Capital markets go through cycles influenced by things like interest rates, liquidity, and how investors feel about risk, while businesses themselves are always growing and evolving. This mismatch means the traditional IPO route can be tough. IPOs often take a year or two and might fall through late in the process. Mid-sized companies also face heavy regulatory disclosure burdens, and market ups and downs can make timing and pricing unpredictable. Additionally, some businesses are either misunderstood or too early in their development to attract IPO investors. Reverse takeovers offer a practical alternative by allowing companies to access public markets even when IPO windows are closed, giving them more control over timing and valuation. They also enable private negotiations without relying on the public book-to-building process, which can be more flexible and efficient for companies looking to grow or consolidate outside the traditional IPO cycle. A reverse takeover offers several practical advantages for businesses. For one, it provides faster access to capital markets, often completing in 3 to 6 months, compared to over a year for a traditional IPO. This speed is crucial when growth opportunities require immediate attention, capital expenditure needs to be deployed quickly, or market conditions are unpredictable. Another benefit is greater control over valuation. Unlike IPOs, where valuation depends heavily on investment banks, institutional demand, and market sentiment, RTO valuations are privately negotiated, grounded in the business's core fundamentals and less affected by market volatility. This can be especially important for asset-heavy industries like resources or infrastructure, where the true value might not be obvious to typical IPO investors. Additionally, RTOs create liquidity for shareholders by establishing a public share price and enabling eventual liquidity for founders and early investors, though this liquidity emerges over time and can involve lockup periods. Finally, Being public allows companies to use their shares as acquisition currency, whether through share-based earnouts or roll-up strategies, which is a significant but often overlooked advantage of becoming listed. The first step is to find a suitable publicly listed company to serve as the vehicle for the reverse takeover. Ideally, this company should have a clean corporate history, minimal liabilities, and enough publicly traded shares to meet listing requirements. These companies are sometimes called listed shells, though they might still have some legacy operations. Next, the parties negotiate the valuation of both the private company and the listed entity, as well as the ownership split after the deal closes. Typically, the private company's shareholders end up owning between 70 and 95%, while existing shareholders of the listed company retain a smaller percentage. Then, the transaction is structured, often through methods like a share-for-share exchange, asset injection, or a capital reorganization. Because many regulators treat significant reverse takeovers similarly to new listings, this stage usually requires preparing a prospectus, audited financials, and upgrades to corporate governance. After that, necessary approvals must be obtained from the stock exchange, securities regulators, and listed company shareholders, which can introduce timing risks. Finally, once the deal is completed, the company often rebrands. New management typically takes control. Trading of shares resumes and capital raises usually happen soon after to support growth. One of the earliest well-known examples is Turner Broadcasting, which used a reverse merger back in the 1970s. This approach helped them secure access to the capital-intensive media markets and eventually laid the groundwork for CNN and a global media presence. Another example is Berkshire Hathaway in its early days, where Warren Buffett took control of the company, originally a textile business, through a reverse-style deal. While not a classic shell reverse takeover, it shows how gaining control of a listed company can transform a business strategically. In sectors like mining and resources, especially in Canada, Australia, and London, junior companies often use reverse takeovers, injecting assets into listed shells. This process turns exploration projects into public companies, which is common when capital demands are high and asset values take time to mature, while IPO opportunities can be unpredictable. More recently, technology and clean energy firms, including those in electric vehicles and renewable energy, have also turned to reverse takeovers. These companies often use this route to avoid the uncertainties of IPO markets, particularly since their business models typically require significant capital investment. One key advantage of reverse takeovers is their speed and certainty. They can be completed much faster than traditional IPOs, usually in just a few months, reducing the risk of missing favorable market conditions. This process also involves lower upfront costs, since there are no large underwriting fees and fewer marketing roadshows required. Additionally, reverse takeovers allow for negotiated outcomes, meaning valuation is set privately and the shareholder structure can be more carefully managed. This level of control is difficult to achieve with a typical IPO. Finally, reverse takeovers offer strategic flexibility. Companies can more easily pivot, make acquisitions, or restructure after going public. They also gain access to public currency earlier, which can be crucial for growth and further capital raising efforts. Altogether, these benefits make reverse takeovers an attractive option for companies looking to access the public markets efficiently and with greater control. When considering reverse takeovers, it's important to recognize several potential disadvantages and risks. First, legacy risks from the listed entity can be significant. These might include hidden liabilities such as unresolved litigation, tax issues, or regulatory concerns. This is why thorough forensic due diligence is essential before proceeding. Second, market skepticism can pose challenges. Many investors see reverse takeovers as lower quality compared to traditional IPOs, sometimes labeling them as backdoor listings or associating them with higher risk. Managing this perception is crucial. Third, liquidity challenges arise because simply being public doesn't ensure sufficient trading volume, analyst coverage, or institutional interest. These have to be developed over time to support the company's growth. Lastly, regulatory complexity can be daunting. Large reverse takeovers often attract scrutiny similar to IPOs, including strict prospectus requirements and ongoing compliance obligations. Companies that aren't prepared for the demands of public governance may find it difficult to meet these standards consistently. All these factors highlight the importance of careful planning and risk management in reverse takeover transactions. A reverse takeover is a smart choice when the IPO market is unstable or slow, but your company already has a strong private valuation that makes public listing worthwhile. It's especially useful when timing is critical and you need to get access to public capital quickly, even if that means trading off some prestige associated with a traditional IPO. However, it's not ideal if your company relies heavily on broad retail investor participation right from the start. Likewise, it's important that your governance structures are solid and that management is ready to handle the increased scrutiny that comes with being public. Without these in place, the challenges of staying public can outweigh the benefits of the reverse takeover. A reverse takeover is a strong strategic option, not an easy way out for weaker businesses. It can provide quicker access to public markets and more control over valuation, which traditional IPOs may not offer. However, success with an RTO requires careful due diligence and solid governance, along with a mindset focused on long-term growth rather than treating the public listing as the final goal. When a company approaches the process as a foundation for building credibility, raising capital, and expanding, it's much more likely to thrive in the public markets. If you found this video useful, there's plenty of more business and finance videos on the channel that you'll enjoy watching and get great practical value from. In the meantime, thanks for watching.